I would start with David, with a simple question, which is simple but not that simple. How COVID has exposed holes and weaknesses when it comes to infrastructure?
Thank you. Yeah, it's a large question.
I know.
And I'll try to be brief and share the burden. I think the main thing is, and we were just talking about it over lunch and chatting over coffee as well, is the required coordination. I think for more than ever before, it's pretty clear that we need coordination between private sector and public sector, between short-term, medium-term, and long-term players, between regional and local and global multilaterals, and also between sectors that are not, I would say, used to working together. One of the things I've found on the sovereign side, because I'll speak more about what I know, is that getting the health ministry to work with the finance ministry directly on urgent sourcing of medication, for example, vaccines, is not obvious, right? These are not these networks are not the normal ones.
Well, no, the way it used to be.
Exactly. They're becoming the new normal, but they were not the normal. So I think the fundamental point that I would make and really invite everyone else to comment on it is the need for collaboration, coordination, and information sharing so that decisions are made and resources are allocated to the right place at the right time. And in resources, I mean also financial resources, obviously.
Right. Well, there's another issue, of course, that's got so much tension. There is, the COVID-19 pandemic has made connectivity more important than ever. Monsieur Bach, all right. Well, I hope that's everything okay there. Now when the world is slowly recovering and reopening, what are the Orange expectations regarding the importance of connectivity, and what are the consumer and business users' expectations when it comes to telecoms?
Let me start maybe with some figures, by sharing some figures. The traffic on the mobile networks each increased by more than 30% between 2017 and 2019. So it's not a recent trend, and telcos are used to absorbing this growth. What's new is that the COVID crisis has been a strong booster since distance communication, just obvious, was so crucial at that time for teleworking, entertainment, or simply for keeping in touch with friends, families during lockdowns. So as a result, we noticed in 2020 an increase of mobile data of as much as 50% in certain countries. So it's true for data, but video viewing times exploded as well, with 3-digit annual growth, plus 150% in Europe and plus 220% in Africa, fueled both by home entertainment and by private or professional video conference. And I would say that even more than impressive figures, the pandemic highlighted how critical the access to economy can be for all public or private sectors, such as application usages, such as, for example, for education. So for us, telco, it has been a source of proudness because this crisis has shown the resilience of our networks under the high stress of activity. And so for us, Orange, it's really, as I said, a sort of proudness in the 26 countries where we operate, as well as in our international long distance. So the question might be now, after this, I hope, after this pandemic environment, is this usages trend going to flatten out? And my answer would be clearly no. Because beyond the extraordinary dimension linked to the health crisis, data shows no sign of slowing down. On the contrary, the high predictions for 2021 and following years only confirm the entry into a new market cycle. For example, working from home is not a temporary fashion, but a structural change in the way enterprises work. And for telcos, this evolution has three major consequences. The first is a demand for very high broadband connectivity. So we continue to boost our mobile networks with new generations such as 5G. But in many countries, it's not enough since our customers ask for very high quality fixed accesses. In France, for example, we registered in 2020 a record of around 2.5 million people moving from copper DSL to fiber in only 1 year. And what's new is that this trend is spreading in new countries, some other countries, and even in Africa, Middle East. And our MEA division consider what's really new, that fiber is a second growth engine. The second consequence of that trend is that connectivity is also a long-distance issue. You might probably know that more than 90% of the world's internet goes through submarine cables, since the data you want to get access to can be hosted everywhere in the world. That's what justifies the current deployment of new generation of submarine cables, and a critical need, I insist on that, a critical need for every country to be connected to these cables. Finally, I don't want to be too long for this first question, but finally, let's not forget that unfortunately, there is still half of the population, 4 billion people, who have no internet, and this digital fracture creates an unacceptable inequality to access to all services and to financial opportunities, to economic opportunities, and Orange is fully committed in all efforts to fill the gap. Finally, our role as telco is under the spotlight. By connecting people, our industry is gradually helping economies to grow, but we are not at the end of the journey. We will face tough challenges in the future with a lot of investment still to be done.
Thank you. Simon, surely infrastructure investment is a tried and tested way to successfully stimulate economic activity, but also surely the situation that we have been through and the situation we are hopefully getting out of and where we're living now is rather extraordinary. How could it be used as a momentum at the same time to redefine the traditional playbook with environmental, social and governance factors gaining momentum? How plans for renewable power are now more attractive than ever?
And that in itself is very exciting. So that's the problem with infrastructure, you have to turn it on.
Well, that's because you're no longer used to participating in those.
I'm used to looking at a little square screen now. So look, I think the rationale for net zero has been pretty much understood by everybody. I'm in the middle of a 6-week tour around Europe and the Americas. And I think every single client meeting, be that corporate or institutional, has had net zero sustainability as a key theme for probably at least a third of the meeting. And within that, clearly getting financing in place to the points that Dave was talking about, to align the different stakeholders to finance is critical. And you can sort of begin to envisage sustainable finance being that sort of intersection between the need for infrastructure and the growth to net zero, the path to net zero. So when you look at what that means in practice, we're now starting to see in many of the countries around the world that clean energy is now becoming a cheaper, if not the cheapest, form of energy. We're seeing many car manufacturers shifting production to sustainable production. We're seeing governments, again, talking, and cities and states committing to a journey for net zero. So the direction of travel is clear, but the playbook is what needs to change. We need that financing capability to be the catalyst for the investment that's required. And I think what I see is multilaterals being focused on it. We see the development with people such as ourselves and multilaterals with KPIs that are linked to sustainability. So that could be thermal emission, it could be metrics for safety, it could be metrics linked to social acceptance. So we're starting to think about what the plays are in that playbook and how that allows us to crowd in investors. Because what is clear is that investors are also on a journey to net zero. They're also looking at how they find homes for their investment, but they need help. So they need to understand the rules of the game. They need to understand that their investment is going to find a good home. And remember that we're sitting here in Paris, but it's the emerging markets that need actually the vast majority of that investment. If you compare the benefit of a solar power plant in Africa to a solar power plant here in Europe, it's probably 7 times the benefit in terms of emissions. So being that conduit and that catalyst. So that's why it was a long answer to playbooks in the process of being written. It's important because we need a clear set of rules to crowd in and to enable financing to bring those various stakeholders together.
Right. Thank you so much. And we're gonna talk a little bit more about it just a bit later. John Gandolfo, Vice President and Treasurer, International Finance Corporation, World Bank Group. The COVID-19 virus has been quite often called on occasions the inequality virus, and the outbreak has significantly impacted infrastructure developments. What is the impact of the pandemic on emerging markets infrastructure, as you've just mentioned?
Okay. Thank you. Thank you very much, and thanks for the opportunity to join the panel today. Let me start by putting it in a broader context and on the impact of the COVID-19 on emerging market infrastructure and the sectors hit hardest. The annual financing gap to achieve the Sustainable Development Goals by 2030 is estimated to be in the range of $2.5 trillion per annum by the OECD, and that comes to 23 or so trillion over the next 9 years. Many multilateral development banks and development finance institutions are very much focused on playing this crucial role in engaging with the private sector to achieve the Sustainable Development Goals. But the virus has pushed the shortfall in the funding from that $2.5 billion number to upwards of 4 trillion now, throwing developing nations clearly off track. In terms of emerging market infrastructure investments, during the beginning of the pandemic, we saw that infrastructure project finance in emerging markets fell by 44% in 2020, and that's compared with 2019. According to the same sources, there have been signs of improvements since then. Overall project finance in emerging market infrastructure was 31% higher in the first half of 2021 compared to the first half of 2020. But sadly, sub-Saharan Africa was the only region that did not see an increase. In fact, they saw a decrease over that period of time in infrastructure project finance on the order of 63%. So a significant decline. And as you can imagine, the sectors that were hit hardest over this period of time were water, oil and gas, non-renewable power, transport. Thankfully, on the brighter side, and as we've heard from some of our panelists here, telecom and renewables have shown either a very strong rebound or really quite significant growth over the year and from the first half of 2020. World Bank studies would suggest that with the right policies and investments of upwards of about 4.5% of GDP would be needed to enable lower and middle income countries to achieve the infrastructure-related sustainable development goals. Now, our view is that there is private capital available for infrastructure investments and climate action. And there's also a strong appetite from the capital markets to build back better and to have sustainable infrastructure projects. But we think that the key bottleneck to that is actually the lack of investable opportunities in emerging markets. And so it's really important that governments also engage to urgently create the enabling environments and allow the investable opportunities to attract the trillions that are needed to close this infrastructure financing gap.
Yeah, we're going a bit more into details on closing that gap a little later. Tofika Hawk, Senior Infrastructure Finance Specialist, Global Infrastructure Facility. Thank you so much for joining us. As we are assessing here the situation as it is now, following more than a year and a half of the pandemic, what's your take on that when it comes to the reality and the impact of it when it comes to infrastructure, particularly, of course, when it comes to those emerging markets?
Thanks very much, Sahar. There is an echo on my side. I don't know if there is an echo.
We can hear you loud and clear. All good here.
Okay, great. I am calling in from Singapore, which is a place with fantastic infrastructure. But of course, Singapore is a bit of an ideal place in terms of size of population, and the reserves of the country. I'm lucky to be the last one to speak because I think my fellow panelists have said it all, so I can just summarize it. But for emerging markets, which is the space where the GIF fits in, we are housed in the World Bank. In the World Bank group, we work with the IFC and the World Bank and all other MDB, VBRD, African Development Bank. We are a global facility. We are at a very particular time. We are at and infrastructure is almost the magic wand that we could get us out of here. I think John mentioned a lot of statistics. Just one number from my side is an IMF World Bank study last year. We estimated that a 1% investment increase in investment in infrastructure correlates to a 3% GDP growth. And in terms of jobs, the estimate is that a 1% increase in infrastructure investments can create up to 7 million direct jobs in the space we are in emerging markets, and up to 25 million indirect jobs. So we're all, as I say, we're all looking at infrastructure, and rightly, when we talk about building back better, this is the space where the biggest impact is felt. And we're sitting at this. We have three challenges at the moment. We have recovery coming out of COVID. We have countries, and this is true for emerging markets as well as developed markets. I mean, debt levels have risen tremendously over the past 2 years, significantly more. I think, again, some figures. I think fiscal deficits in Africa are at an average of 70% of GDP. In Latin America is around 75%. I mean, those are very important numbers. So look, and then of course there is the climate crisis, which is staring at us. And I think it's staring at us. We are opening our eyes. And I think our children who are getting out on the streets asking us, what are we leaving them as the world is loud and clear. And I really see a shift in this space where we are thinking of how to leave the world at least not worse, and if possible a bit better. And Simon mentioned this thing. We're seeing that it's possible to do good in the infrastructure space, to make acceptable and good returns, and come up with solutions that are also good for the climate. So his point on renewable energy coming in at par or sometimes cheaper than more traditional energy is definitely a big boost, and with improved technology. So solar, it was only 5 years ago that it came out to be cheaper than gas-fired power plants. And we hope that in 10 years from now, solar with battery storage is going to be affordable and will really revolutionize renewable energy. So in emerging, and then this triangle of issues that we have to handle: climate, recovery out of the pandemic, and debt issues, are true for all countries, but for emerging markets, they are even more acute. And I think each of the panelists did mention the constraints on public budgets and the need to bring in the private sector, which is a challenge in many ways. In emerging markets, even more so. And I think there is there is tremendous work that needs to be done in trying to bring the different stakeholders, the public sector and the private sector, to look at the risk and to be able to, each party to come together to look at the other party, what it has to offer and what must be conceded in order to bring the other party in. So that's the space that's the focus that we, the MDB world, the public sector world, are putting a lot of emphasis, which is how do we prepare these infrastructure projects? How do we make these bankable infrastructure projects that will be able to attract those trillions of assets under management, which is not an easy task, especially in the current market today.
And before we go into the issue of debt, which is another big conversation to have here, of course, let me go into a different time frame situation. Mr. Gandolf, to you, when it comes to closing the infrastructure gap, how COVID-19 has changed the time frame around the issue of closing the financing the infrastructure gap and meeting those UN 2030 SDGs?
So thank you. As I said earlier in my comments, the financing gap has increased, and so it's the time frame has it's just getting shorter and shorter to 2030, and the gap has gotten larger. So the efforts to close the gap are ever more urgent. I think in order to bridge the infrastructure financing gap, a couple of things are necessary that I'd like to highlight. We know that in emerging markets, you need to have the right macroeconomic situation, you need to have political stability, the right regulatory environment, et cetera. But I think you also need to have robust pipelines of bankable projects, and those don't just appear. And we think that you actually have to work what we call upstream in order to create the environment and the conditions for these bankable projects to actually come into existence. One example that we did was in Cameroon for Noctegal hydropower project, and that took 5 years of upstream work and costs and so forth, and we did it in partnership with the government of Cameroon and EDF, and it eventually developed into a structure that allowed the financing of 800 million plus euros from DFIs and international financial institutions and local banks in local currency, in fact, to finance this. But it's more and more identifying and making these bankable projects happen is very important. A second piece that I wanted to introduce is also the need to build on what I would call existing financing mechanisms, but to also recognize that some of these investments won't be able to stand on their own feet from the get-go. And so blended finance, finding ways to blend financing to de-risk projects becomes very important as a way to help to close the gap. And that is more and more necessary in fragile states, in the poorest countries, what we call the IDA countries. And finally, also developing platforms that are scalable to allow international institutional investors to invest alongside some of us who have been working in the space for longer periods of time, so they get more comfortable with the overall risk-return profile. Thank you.
Maybe just building on that, it's only in a forum such as this that you've mentioned $4 trillion and sort of move on. I mean, $4 trillion is clearly a huge amount of financing required, and to your point about timing, clearly the urgency has increased, and the sort of opportunity cost has changed as well, because certainly governments are thinking about water, healthcare, sanitation as perhaps increased priorities over those projects that have a climatic impact. The good news, I think, is at the same time the tools to finance have got more and more sophisticated. And we talked about green bonds and investors' appetite for KPIs that link to sustainability. So I think we're seeing a much greater pool of funding available to these. But the key, exactly as John says, is you've got to enable that funding to go to the right places. And I think we're seeing investors generally looking at sustainable opportunities, but becoming more risk averse. So you've got to have that blended finance structuring to crowd them in to stand a chance of hitting the timeline.
Let me just quickly here.
Sorry,
Yes.
could I come in here?
Please.
I think to Simon's point on financing becoming more and more sophisticated, definitely. However, the fundamental risks in infrastructure projects remain what they are. So construction, land, off-taker risk, environment and social impacts of these large plants. So to join John's earlier point, which is you need to, and the point I was making earlier, fantastic that so much money is available in the market, but if you don't prepare projects that are well structured, that money will not come. Investors will, and definitely not in emerging markets where there are issues of political stability, macro growth. So I think we are the positive things I see is that everybody is aware of this, and even completely private and commercial investors are getting into alliances with people like ourselves, with the World Bank, with the IFC, with the GIF, working in this space of here are our conditions. We want to be in emerging markets. We're willing to take that risk because we expect returns, because risk and returns go together. But we need, at minimum, we need these conditions to be met, and we will come early with you. And that's what we do at the GIF, which is we bring in the private sector as well as the MDBs to work together, saying, okay, let's make deals that will bring in the money required. The previous session, we had the Minister of Infrastructure of Ukraine, the GIF, together with the IFC and EBRD. We were very happy to support 2 port deals that closed last year. So difficult year, but 2 big successes for Ukraine because those projects were prepared in a way that attracted world port operators and financiers in there.
Let's carry on here. Monsieur Barr, what's your take on that?
Yes, first, I would like to say that, like Simon, it's the first time I see so many people in the same room, but don't forget that there are thousands of people looking at us through video. So it shows that the world is different, and so we need, of course, to be physically together, but also to have a very good connectivity. So, and concerning this connectivity, it's both a need in Europe, for example, but also more and more in emerging countries. And what does it mean for an operator such as Orange? I mentioned earlier mobiles 4G and 5G. Fiber is a key issue. I say that it's the beginning of the story in Europe, Africa and Middle East. In Europe, it's more. We are more at the end of the story. We are on the final track. We have already 50 million connected plugs in Europe, but it has represented almost 30 billion euros capex. So it means that pursuing and continuing the program of development in the emerging countries is a huge stage, which represents a lot of money to be invested. I mentioned also in my first answer the question of international networks. At Orange, we are committed. We are present in the 450,000 kilometers of fiber. We partner in new projects, such as the one launched by GAFAM, players like Google or Facebook, du nom Amitié. There is one project, there are several projects in Africa, and we partner in the so-called Project to Africa, which will be connected to 23 connected countries in Africa. Don't forget that there are also needs for terrestrial backbones. And for us, we consider that in Africa, for example, there is still a lot to be done for that. We have launched the first international fiber network in Western Africa called Joliba, which is absolutely necessary to connect the local internet to the world internet and to connect landlocked countries to submarine cables. So it means when you add together these huge needs in terrestrial backbones, submarine cables, and the deployment of fiber, that there are a lot of needs for investment, not only a lot of needs for investment in the future. It's a question of economy, it's a question of digital fracture. Orange is committed. We have a very ambitious and demanding program, but we need, and that may be the next question, but we need definitely to leverage some external funds and to find new types of partnership in order to be able to face this huge challenge of investment.
Simon, what's your take on this new type of partnerships when it comes to bringing that investment together?
I think it's exactly as we've been talking about it. I don't think there's not a shortage of liquidity, there's not a shortage of capital. What there is a shortage of bankable projects. And I think everybody's mentioned that in one way or another. So that concept of blended finance, bringing in government support, bringing in multinational agency support, bringing in debt capital markets, bank finance, with very clearly established KPIs that we all feel comfortable with in terms of the direction of travel, I think is what, if anything's changed, that's probably accelerated more than...
the balance between those aspects. David, what's your take on this new type of blending and partnering, and also what's the view and the perspective of the governments when it comes to those?
So I think this is very relevant, but what we're seeing, I think, is very much different sectors of the community, the private sector, public sector, as I said, the multilaterals, regional development banks, commercial banks, all working together to meet a challenge. Let me just make a couple of comments. And obviously connectivity, there's some sectors are hurt more than others, right? So that's critical. And those sectors are going to have to be somehow or other rebalanced or restructured, one or the other. Infrastructure happens in a country or regional framework, right? So it's the first thing we need to do, in my opinion, is also make a clear assessment of what the debt burden and the sustainability of given countries and regions are. So, for example, the DSSI initiative, which I think is a very good initiative, but doesn't go far enough. It needs more. We need more. The global framework that has been put together for, which actually I don't know if everyone knows it, but it's for a different category of countries that didn't benefit from. John was mentioning it from the DSSI. All of that needs to be coordinated and looked at in the same framework and within the same kind of time frame as the infrastructure. You can't separate infrastructure from the physical location of where you have that infrastructure. The two work together. So I think one thing that's happened is there's much more coordination between the sovereign side, let's call it, and the project side. And I think that needs to actually go even further. I don't think it goes far enough. I think it needs to go further. The second thing I would say is that what we've seen with the pandemic and Jérôme, Orange, for example, and the different connectivity operators show us that we need more connectivity, right? So we have global issues, but they have local consequences. The pandemic itself, it's a global pandemic. It started in one place, it ended, and now it's everywhere, right? So we have, and of course, emerging markets and emerged markets don't have the same capacity to respond.
It's very uneven.
It's very uneven.
And that becomes the way it goes, and then the way it recovers.
Exactly. And let's just, two final quick points just to really answer you. One is we lend to the rich. We're very good at lending to the rich or to the sophisticated. We're much less good at lending in sophisticated financing, which is the blended thing that we're talking about here, to the poorer, the less sophisticated countries. One of the things I'm trying to do with my team is we're trying to go to places where the World Bank goes there, but it goes there very much on the base level programs, right? Which, nothing wrong with that, it's great, they need it. But actually what we need now is to accelerate the private sector, the mixed, the blended type, and that takes on the ground sophisticated financing capabilities at the government level as well, because you need somebody to talk to, right? There needs to be connectivity also in the discussion. And finally, I just mentioned the SDRs, right? For example, one of the really good initiatives the IMF took this year, and I think the global community took, was to increase the SDR allocation just to give unrestricted help to countries that are struggling. And one of the, again, this goes with the extension of the global framework, right? One of the ideas is to use some of those SDRs, number one, to allocate them to the emerging countries and not to keep them, because they're based on the capital structure of the IMF, right? I won't get into the detail of it, but to allocate them more to emerging markets, and perhaps also to use them as collateral, partial collateral for projects. So these are all new ideas that we need to develop that all go to this idea of convergence.
No, I was just thinking.
Yeah, because I saw you reacting. That's why.
I was just thinking on this point of connectivity. We're all here today, having survived the pandemic because of Orange and people like that and connectivity.
Thank you.
Had we not had that connectivity,
yes,
the world would have been a very, very different place. I mean, you couldn't ask for a better stress test than we've gone through, and an example of what you need to survive.
No, we didn't really ask for this one.
The future is bright. The future is orange, I think.
That's a good one. What do you want to add something on this?
Maybe just to add that, I fully agree with David that, we've been talking about blended finance, and I sit on the blended finance committee in the International Finance Corporation in IFC, and we certainly look at different structures, bringing in donor funds, IDA money that can be utilized for FX risk coverage, first loss sorts of coverage, possibly interest rate buy downs, those kinds of things that can make the project more sustainable from the point of view of the client. And of course, from the other part of the World Bank Group, our multilateral investment guarantee agency, MIGA, and political risk insurance and so forth is another way to de-risk these kinds of projects. But the amount of money that's needed to blend has to go up. There's insufficient amount right now.
John Barr.
Yes, coming back to this question of
Let's go back to this question, yeah,
Yes.
and also I wanted to ask you on this one, and also a little bit more on around strategy when it comes to this.
Yes, but I think that you see, I'm talking about telecommunications, but I think that there are a lot of conclusions which might be transposed to other sectors, you see. I think that there is a pressure. You see a pressure on investment, pressure on margins, because you see retail activities are under pressure. The market is asking for more cash flows and for less capex, which is a sort of paradox and sort of potential contradiction. And I think that we have definitely to find some new partnerships, probably more sharing of infrastructures, probably new vehicles and sort of affiliates and joint venture between the private and public funds, public funds and companies, traditional companies. And so I think that we have something to reinvent in the next years.
Thank you very much. Tafika, can you hear me? Let me bring you back to our conversation and ask you a little bit more in details about the FAST Infra initiative.
Thanks. I was actually going to mention this when we were talking about connecting the stakeholders. So the FAST Infra initiative was launched actually about 2 years ago by President Emmanuel Macron and the One Planet Lab initiative. And it was really a question asked to the private sector, to private financiers, investors, saying, how are we going to finance this and how are we going to accelerate the transition to a transition economy and move away from the fossil fuel heavy economy model that we have been following? The GIF and the IFC, together with HSBC, Macquarie, and OECD, were founding members of the Finance to Accelerate the Sustainable Transition, that's FAST Infra, of coming up with practical solutions that are designed actually with the funds that are ready to be deployed in emerging economies, but also in developed markets. And one of the pillars that we, the GIF, have been leading together with Macquarie and HSBC has been of developing a sustainable infrastructure label, which would be at the asset level as opposed to what we have today with the sustainability-linked bonds or green bonds, which is always at the finance level, or so the financing needs or the financiers require certain level of due diligence and preparation of assets or financing structures. Whereas here we took a position saying that if we are starting to plan and build assets that will meet the criteria that we have set in the sustainable infrastructure label, it would actually signal to the market, to those investors who have asset allocation requirements of putting X percentage, and we're seeing that X percentage growing over the years, actually growing very rapidly, with commitments coming saying we have to meet our own requirements, but it's complicated to understand all of these different environmental standards from one country to the other and our own regulators' requirements. So this label that we are working on is trying to respond to this, which is plan and build an asset meeting those sustainability requirements. And investors, it will make it easier for investors to get comfort, hopefully make their due diligence process simpler, and eventually translate into a more efficient cost of doing a transaction, hence some efficiency in the cost of funds that are being proposed for those assets. And we have been working on this with under the FAST Infra umbrella. So yes, we were the founding members with HSBC and Macquarie, and IFC was heavily involved. But we had a working group consisting of essentially commercial banks, project finance banks, as well as institutional investors, pension funds, who were actually telling us, this is what help us meet our requirements and build an asset that's going to build a label that's going to be workable.
Thank you very much. John, would you follow up on that one, on this initiative and on this, or the need to do that? And also I wanted to ask you, what is the International Finance Corporation doing to increase local currency financing to infrastructure?
Sure. So, you know, first off, we think that local currency financing is very critical, and we think that, you know, in many cases these companies they should not be taking the FX risk, particularly if the revenues that they're generating from what they're doing is in local currency. And we've seen over the last decade how, and over much longer periods of time, how the volatility in emerging market currencies can totally swamp the returns in a market. So we feel very strongly that developing the capacity to offer financing in local currency is really important. But that gets back to some of the things that we're discussing on the importance of capital market development and the importance of having the right environment. And, you know, we've been successful over the years. We've been able to make local currency available in 80 different currencies, including, you know, Armenian dram, Uzbek som, Zambian kwacha. A week ago, we were able to issue in the offshore market, first time ever, in Sri Lankan rupees. So we've had some success in this, but it hasn't gone far enough, and you just need to continue to work on the development of the capital markets in order to make this happen broader. And I think, you know, we've worked with some of the partners here, in fact, in making local currency available. I also wanted to mention, just follow up on what was said on making due diligence more efficient. So one of the platforms that we have developed is what we call our Managed Co-Lending Portfolio Program, or in the World Bank Group, we like acronyms, so MCPP. That is a way for investors to give money to IFC that we will then invest alongside our own sort of, call it our A loan. They don't have to do the due diligence. They don't have to, we will, subject to certain criteria and rules, develop a diversified portfolio for them that should behave pretty much like IFC's portfolio, right? So they don't have to go out and do all that due diligence, and they can take comfort that IFC's E&S standards, or our performance standards, our integrity due diligence, et cetera, is all being done in order before we undertake that project. So that's another way that we can crowd in.
Mr. Barr, what do you think on that one? What's
yeah.
your...
No, yes, I think that you see Orange is both a big worldwide operator, but also present in the 26 countries in Africa, more than 220 countries in the world. And we do think that we need to be partner at several levels, locally, internationally. And so I really do think that this question of local currency and global partnership with international funds are both keys for getting the right partnerships.
Thank you. Well, we haven't argued, because it's impossible to argue, that obviously investment in infrastructure can provide this necessary boost to the economic activity. But we have discussed that it should be different blend, should be different approach, should be different way of partnership. But Simon and David, the question goes to you two now. What about this conversation and some criticisms when it comes to a trade-off between debt sustainability and infrastructure investment? Because this is something that we've been hearing a lot as well.
Go first?
I don't mind.
I want both of your views on that one, yeah.
Okay, so we'll do it. Yeah, go ahead.
It's the first time I've been in a group of 6 people and agreed with everybody, which is not often the case.
That's why I'm moderating.
Yeah, fantastic. So look, and David talked about DSSI, which was clearly a necessary initiative when you saw the sovereign debt levels spike up to levels they did to deal with the pandemic.
Did it make you worried?
Yes. And that's the point I was going to come on to, that I think it's not just made me worried, I think it has made investors generally worried about sovereign credit. What that means for infrastructure financing is that people's assessment of risk, because if you like, move down the investment curve. So people are much more assessing, which is why the work that Global Infrastructure Facility are doing, et cetera, is so important. People are really looking even more closely at the risks around the direct asset they're investing in, because they have less confidence at times in the sovereign being there to bail them out. So everything we've talked about blended finance, about different strata of asset class and being really comfortable that the project is investable, actually is magnified, I think, as a result of DSSI.
So I agree with that. And I agree with Simon as well, that this is a very consistent, and Sasha, I know that you're moderating, so you're keeping it all together. But just a couple of points, I think, just to add to that. One is that this is our moment, right? We know what the needs are. We have a very clear quantification of needs, but we still haven't fully, and I think that's where the criticism comes in, we still haven't fully developed the delivery mechanism to get the money to the projects, right, and to the sovereigns. Because your point is that it's an ecosystem, right? You can't separate the two completely. It would be nice to be able to completely, as a project finance lawyer, which I used to do before, to be able to put a ring around a project and totally isolate it and put it into kind of limbo. But it doesn't work like that. It's in a place, right? A physical location with everything that goes with that. So reducing debt levels and at the same time maintaining infrastructure capability is really our challenge. How do we keep, because this is about people, right? We're talking about returns, and we're talking about blended finance and sophisticated, MEGA, et cetera, but at the end of the day, what we're trying to do is actually get services to people, right? And that's the role of governments. So governments are facing a huge challenge at the moment between their debt levels and being able to keep those infrastructure projects moving. I think the final point I'd make is that on this particular thing is we've done a lot of debt deferral. I think we need some debt reduction to reduce levels of debt as opposed to just pushing it forward. Because I think at some stage, we need to actually face the bill, l'addition, as we say in France. So.
That's why I get nervous.
Yeah, that's what I'm asking you.
Yeah, no, I'm pushing this over to you.
Well,
it's not my bill.
Just a few months ago, I talked to Angel Gurria, of course, who was running the Organization for Economic Cooperation and Development, and I asked him, Mr. Gurria, well, what do we say to the next generation who will will have to pay the debt? And he told me, well, it's always the next generation paying the debt. He was just like, that's the way it is. So he was also having this.
It's tough. I mean, the math doesn't work with the current balance. The question comes as to who carries the pain, because there will be pain. And as a result of carrying the pain, what does that do? Because if the result of that is the investment community in its broadest sense gets too scared, then everything we've just talked about stops.
Of course.
And that's a disaster.
And the momentum is gone.
And the momentum's gone. So that's why we have experts.
That's why I left this question towards the end of the session as well.
No, it's a real balance that needs to be struck. Absolutely.
Ms. Haug, what's your take on this? Can you hear me?
Yes, I can hear you. I think we're coming towards the end of our session. We need to leave with some hope and positivity. So, yes, I agree. I agree with David that just to postpone, just to restructure the debt is not going to be sufficient for certain countries. Forgiveness is always a difficult. There has to be some objectivity, KPIs. It's a complicated process. But I come back to the opening point of why are we also interested in infrastructure? We are working towards growth, right? So that the capacity of these countries to come out not only of this crisis but to grow. And I have tremendous faith. I think Jérôme spoke a lot about Orange and what it is doing. I mean, the world economy, the structure of the economies of today are completely different than what they were 20 years ago. And even in emerging markets, I've been working in emerging markets for the past 25 years. The growth levels, you see a country, I sit in Asia, a country such as Bangladesh, which has sustained 6.5% growth for the past 10 years, and which was until 30 years ago considered as a basket case country. It's a land of returns. I think I see Simon nodding his head. Standard Chartered is well implemented in Bangladesh in various sectors. Even for us, I think the first IPP, private investment in power, was done with a World Bank guarantee back in 1995. IFC has done a number of power deals in the past 10 years in Bangladesh, providing private lending to commercial entities. But these days, until COVID, there were financing being done in Bangladesh without MDBs being involved. I mean, that is progress. And we continue to see, and we continue to work towards that kind of growth and progress. And infrastructure is really the engine for all of this. So I mean, that could explain why such a high level of interest in the subject everywhere, from President Biden's plans for America to what we are doing, the World Bank Group and others in countries such as Solomon Islands. So, yeah.
Thank you. Jérôme Barre, your concluding comments on this issue.
Yes, maybe some messages about...
from your point, yeah.
Yes, from my point and the specific issues of telcos. We are in a financial, very complex situation because you see we have lots of investment to be done in front of us, high demand from our customers. pressure on EBITDA. As demand coming from our shareholders to increase our cash flows and without big capabilities to increase our debt level. So we have definitely to find something else. As I said, sharing infrastructure is absolutely critical because I think we cannot spend for several infrastructures, but it's probably not true only in the telecom sectors. I think that we can create vehicles, common vehicle with funds for two reasons. The first one is that just for raising funds, which is just an obvious reason. And the second is that don't forget that the multiples, the valuations, the multiples of EBITDA in the infra cores is much higher than in telecom. Us telecom we have now a multiple by around 5, whereas the infra cores have multiples between 15 and 20. So for us, it's absolutely too critical to create that sort of vehicle in order to be able to participate, to reveal the value of our asset, and to participate to the consolidation movement of the market. And last but not least, I think there are a lot of new projects coming from local authorities, coming from states, coming from funds with RFPs. And I think that it's also an opportunity to launch new projects because definitely we need, if we want to continue just doing our job and extending our network, we definitely need to invent something new together. I think it's very important as business stakeholders. It's very important for Orange for its financial results, but it's also very important as what we're doing helps countries to develop their economy, the digital economy, and help people being connected with the rest of the world.
John? Just to make a couple final comments. One is that first, the DSSI was absolutely necessary. You know, at that time in the crisis, stopping the pain was absolutely necessary. But I agree with some of the comments here that debt reduction is probably necessary as well because there are some things that have been financed that are not sustainable. And it is true that the next generation has oftentimes paid the bills, and we've obviously seen how that has gone in the climate change space at this point in time. But on the financial space, you know, if you have strong economic growth, it's digestible for the next generation to pay those bills. If you have slowing economic growth, then it becomes more difficult. But I think that if you invest in the right and sustainable infrastructure, sustainable environmentally as well as financially, then it does have the power to create economic growth, and it does have the power to create jobs. And I think that's the key to, or very critical to infrastructure financing going forward.
Thank you very much. Thanks to all of the speakers participating. Tefika, thank you so much for joining us today.
Thank you very much for having me.
Thank you. It wasn't all, you know, it was optimistic. It was not all that doom and gloom, but also it's been a great food for thought for everybody here in the room as well, and everybody following us online as well. Thank you so much for this session. Have a great afternoon.